Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. As we enter this first notice day for March contracts, we can see very clearly that the market has given us a very big run for this corn contract as it moves up to test that key 374 half number that we've been talking about before as overhead resistance. The market had come down below our 2x1 angle and for about 5 to 6 days was trading below, and today we can see very clearly it's back above. And you'll also notice that the key 1x1 angle that we discussed previously did not break, suggesting that the market could very well make its way up to resistance near that 374 to 375 number. We have only about 2 weeks left before this contract comes off the board, and we're looking at potential resistance then at 380, and from there looking for the market to turn back down, as would be seen in the forward contract since this contract is coming off the board. The move today has managed to reach our volatility bands overhead, and additionally at the 380 mark that we discussed previously, that happens to be one standard deviation below the point of control. It stands to reason then that despite the very big move that we're seeing today, the possibility of weakness coming from here for the next 2 weeks is very plausible, especially if the market were to go sideways going into the 7th and then one more week from there looking for a nice move to the downside. The May contract has done very well in sustaining the 2x1 angle, never really getting close to the 1x1 that we discussed as potential support in the event that the 2x1 did break. Overhead resistance sitting at 381 was now been broken as of today's move, and it remains to be seen whether or not the market's able to close either above or below this number. In the event that the gains from today are surrendered and the market closes below this 381 number, that would be a precursor for potential weakness, especially as we approach our next time factor date. Something else that we wanted to bring to your attention, going from the previous low in this market here, we made our way up, and about 45 days from there, we looked for a potential resistance area coming in. And part of why we believe this might be potential resistance is that the market made a range of 25, and the last time it made a range of 25, the market did course correct. In addition to that, that range was at 7.07%, and that happens to be a very important number as it is 1/2 of the square root of 2. Additionally, the market was at 29 trading days, which is very close to a key 30-day mark, and being at 45 calendar days. So having this number of items all come together near this time threshold suggested that a top was very close, potentially. The market made a very big bounce to the upside today, as we can see, and again, we're looking to see the way in which it closes over the next couple of days. Next big level for this contract appears to be at the 180-degree mark at 389.5. And if and when this market actually is able to get to this area here, we anticipate that the market could very well find some softness. Again, as mentioned, for the March contract, the market is sitting right up against our volatility bands. And we can also see very clearly that the market has now posted a support resistance band to alert for us, suggesting that the market could very well be sideways or at least course correct over the next 5 to 7 trading days. We can see where our time factor of February 20th came in very well. The market dropped and gave us very good support right on top of our horizontal tangent line. The next key factor then we're looking for is about March 13th. So if the market were to go sideways or even move up into this timeline, this is where we'd be looking for the next move to the downside in particular. Again, as mentioned before, we have 389.5 is very good resistance potentially if this market's able to get through this support resistance indication mark. And with our next horizontal time factor coming in just above that 389.5 number, we think this area is going to be very difficult for this corn contract to get through. Soybean has been slowly creeping its way up. And if you go back to the initial move that we had been looking at, we can see where the impulse move for this move in comparison to the current move right now gives us some very key levels. At a 1-to-1 correspondence, we can see the 1028 mark that we had discussed previously. Upon first attempt here, we can see the market came through, reversed back down, and found a little bit of trouble there, but was eventually able to get through. From there, the market then gave us a bit of a consolidation, and now the market is testing just above near that 1044 half number that we discussed previously. The market now is trading just above that number, and we do have resistance coming in at right about 1047. In the event that we're able to make a couple closes above this 1044 half number, this market is then predisposed to being able to make a nice rally to the upside. Now, mind you, there's only 2 more weeks left for the soybean contract, so we'd be looking for this to manifest in the upcoming forward contracts. The corresponding key level for the July contract rests at 1065. And it's at this number, in the event that we can see July bean make a close above this area, suggests that coming up and touching at a minimum 1086 is probable for this move and potentially even higher. We've long been calling for the July contract to make it up to about 1100, and the way in which this market is moving looks like it could very well do that. A couple of caveats, though, that we want to bring to your attention. As we look at the way in which this market is moving, we would consider this the initial impulse move of what is looking to be a very strong uptrend. If we were to look at an Elliott wave movement, this would be wave 1 followed by wave 2. Wave 3 now is possibly in play, but the market needs to get to about 1086 to confirm that we are in fact in the midst of a wave 3. If this market were to fail from here and come down and breach 1025, then all bets would be off and we're simply looking at an ABC correction for the move back down. In the event that the market does make its way up to this 1086 number, we now have a completed 3-wave pattern, at which point the market could just simply make its way up to about 1100 before finding a bit of a correction. And from there, we'd look for a sideways movement before the market makes its final leg up to a wave 5 position. So now we're looking at the potential for a wave 3 to establish itself, a wave 4 to come in after a meaningful correction, and then a final wave 5 move to the upside to complete this up leg for soybean. Soybean has been very strong as of late, especially with the conditions that we have seen in Argentina, and so the way in which this market is moving continues to suggest that there is more upward potential for beans ahead. We can see this movement that we're seeing here is starting to shape up very much like a continuation pattern. And so we want to reiterate that we think that 1100 is a probable target for this contract. From this vantage point, we can see where we have 2 volatility-based resistance bands overlapping one another. And as this overlap is taking place, we're seeing more and more strength potentially for soybean. It gave us an SR1 level, but we can also see where our bands are starting to stretch to the upside, and the next key overhead resistance level lies at our 360-degree mark at 1080. So again, we're looking at between 1080 to 1085 as near-term targets for now, and upon getting to this area, 1100 could very well follow soon thereafter. The surprise move of the day is perhaps in wheat, and we can see where a consolidation had occurred. A couple of days ago in the published newsletter that we had, we talked about how this consolidation phase in which it's in can resolve itself on either side of the market. In the event that the market were to resolve itself above this 466.25, we were looking for a potential move that would mirror at a minimum the length upon which the market made going into the move on the other side on the back side. We're now seeing that the market in simply one day was able to satisfy that condition, come up and touch about 482 to 484, and the market is trading right up above this area right now. Given the strength of this advance, though, we anticipate that this may not be the only day for it. Given that it's very close to being overbought, we still are not seeing the red and we're not having a crossover as of yet, suggesting that the market would make a move back down. The next key area then we'd be looking for overhead sits at about 500 or very close to the point of control at 496. So these look to be some 2 key areas for this contract as it rolls off of the board over the next 2 weeks. A major target threshold that we'd be looking for moving forward to the July contract would sit at about 524 to 525. And upon reaching that 525 area for the July contract, we'd be looking for some potential softness for there since we have our one-to-one correspondence. If the market were able to blow through that 525 number, then we'd be looking for continued strength potentially. It remains to be seen the way in which it responds to that area. We'll simply be waiting to see if the market's in fact able to get to that number. This chart shows us how the market likes to respect some of those degree angle factors that we've discussed in the past. We can see a bit of consolidation occurred at our 360-degree mark at 424. And if you recall from several weeks ago, this had been a very important number for us in terms of finding support, where the market dropped into this area and then finally was able to bounce back up again. It moved up 90 degrees, and from there we can see the consolidation that occurred between the 270-degree mark and the 180-degree mark at 466.25. The consolidation lived right inside that band, and now that the market was able to break through the other side, it moved again another 90 degrees where we're finding potential resistance today, right at that 488 number. The last area we want to bring to your attention is the 413.75, which is where this initial move first started. And we can see just above a potential top end area sitting at 499.25. So if the market were to continue to mirror itself on either side of its movements, we would look for a final top to come in either somewhere near this 488 or the 499 number as he looks to roll off the board. We'll close out with the dollar index. And if you recall previously, we discussed how we're looking for a potential corrective target to sit at about 91. The dollar made a very nice low on January 30th. Made a nice bounce up to resistance, came back down very close to our target that sat near $88. And now the market has since been making its way back up again, and we had discussed a very good probability of the market coming up to about 91. We also have our volatility bands coming in, and the way in which this market now is moving, we would not be surprised to see a very nice corrective move come into about $92. This nice ABC leg that we're seeing is very typical for a movement after an important low has been made. We'll simply continue to trace the way in which this market is moving, but we do like the way it's coming up against our volatility bands. And as you can see from here, it suggests that a shift to the downside would happen. So once our new volatility bands are posted, we believe that the dollar can find very good resistance inside of this $91.50 to $92 area. The weekly perspective shows how the dollar had been in a very nice range that had been sitting right inside of our volatility-based support band for the weekly chart. And now as it's making its way up to our $91 target, which was the previous low, if the market gets up and gets through to perhaps 92-ish or so, we could see a little bit of a movement that even creeps up a little bit higher before it looks to potentially turn back down again. If the market does find legs much higher than 92, then we're looking at the potential of a retest of the previous highs, which suggests that the dollar could make it up to about 95. So between 91 and 92 are two very key numbers that we're looking for with the US dollar. And from here, we'll continue to monitor the way in which it moves. Thank you so much for joining us for our weekly market update. Look forward to touching base with you again next week.